Yes.
Trustee Martin,
Yes.
and Trustee Riley.
Yep.
We have a quorum.
Great. Thank you. And I'd remind participants to please leave your mics on mute when you're not speaking. The first item is to turn the meeting over to our presenters, who would be, let's see if they're here. Is it you, Tracy, or? Samantha?
Yep, Samantha's here.
Okay, yep. Okay, I'll turn it over to you, Samantha, on tab 1.
Yes, good morning. I apologize. I'm reporting from our cross-country championships that we're about to kick off at 10 o'clock. So I'll try to be quick, but I do apologize for any interference or teams in the background as we're at Penobscot. So beautiful day for end of the October championship where it's going to be 70 degrees. So we had our yearly audit committee audit that we have with our athletics, specifically in the compliance area. This year, they looked at 5 different areas, one being our governance and organization, camps and clinics, both recruiting off and on campus, as well as individuals associated with a prospect. This year, we did have a handful of recommendations, not so much findings, but recommendations. I would say a few of the biggest ones regarding our camps and clinics. I will say the 22-23 year was us kind of ramping back up from COVID to having full camps and clinics. So there was a little bit of kind of lapse also too with a little bit of new legislation that came in specifically regarding advertisements and working through that. So we also additionally, some of the recommendations were regarding our staff turnover. A lot of it, we've had a decent number of staff turnover within the past year and a half. So myself at our office doing a better job educating our new coaches and staff members on our policies and procedures and giving them some additional education. And then lastly, our audit does kind of show a few holes in our or chinks in our armor within our department and just kind of the way we reevaluate and go over our areas of compliance. So from this audit cycle, we've already begun to put policies and procedures in place with new monthly monitoring and automatic auto-generated reporting from our online systems to alert our staff of different off-campus of different recruiting activities for our coaches. So kind of off-campus, whether it's logging telephone calls with prospects, visiting prospects, anything like that, as well as monthly practice activities. So we've already put a lot of things in place. We continue our yearly audits. Obviously, we have a 4 to 5 year cycle that they go over 4 to 5 different areas every year. And would imagine that new areas will pop up as we continue to kind of proceed through the NCA. And not sure how well you all follow that, but kind of changes every day. And then also too, with the transformation committee recommendation that not only the conference office, but individual institutions do an audit at least every 4 or 5 years. So we are well ahead of the curve. We're pretty much the only school in our league that does yearly checks and balances auditing systems within our university. So every year I look at this as an opportunity to figure out how our area can get better and what things we can put into place to, just make our jobs easier, but also to make sure our coaches are abiding with NCAA rules, especially as they change kind of on the drop of a hat lately with everything. But happy to answer any questions that anyone has, specifically kind of with the areas that we've covered this year.
Thank you very much, Samantha. Just one question I have is, how different in the audit you do for the university different from the other audits that you have to do with the NCAA or?
Yeah, so this year is the first year they're requiring a lot more. The NCAA calls them attestations. So for instance, we've always had to do a Title IX attestation, which basically is specific to Title IX education. So making sure our coaches and student athletes and staff are aware of that. And we work with the we work with the Office of Student Life to make sure we meet those recommendations. I would say our audit that we do yearly is really looks at how us as a compliance office operates. So they deep dive in, if, for instance, monitoring our monthly activity with our coaches, how we're monitoring their practice activities, who's signing off on them, how long do they go. So we have an auto generated report every month. Our student athletes signing off that yes, they completed this number of hours within 2 days, 5 days a week. And, it's really more nitty gritty for our policies and procedures and how we're specifically doing things at the University of Maine in the Division I level, where the attestations that the NCAA require are more of a specific niche area overview that we have to sign off that we have specific education on, and that we're making sure we're educating our coaches on that specific area.
Good. My last question, I'll turn over to Trustee McMahon is do you do for yourself like an internal type of audit, say halfway through the year, just to see if everything's going in the right direction, and can you use that stuff for your audit when we actually have to do an audit at the end of the year?
Yeah, so I will say we do take stock. Unfortunately, but also fortunately, violations do come up throughout the year. We're not doing our jobs effectively if we don't have at least a handful of violations every year. I mean, they're not egregious like some of the stuff you see on like ESPN or Sports Center, where it's academic integrity. It's kind of small things like coach by accident texted a prospect that's of the wrong year. But a lot of, as we go through the year and as we go through different things, we kind of do an internal check of, okay, where was the hiccup with this? Why did this happen? What can we do to make this better? And we typically, we don't know the audit topics probably until we do it in July around May. So it's hard to see what we're being audited on specifically for the year before, but we do kind of keep a running tab because, like I said, every 4 or 5 years we cycle through the same ones, and then just use that and also use our experiences as we go throughout the year to kind of shore up our practices and make things better. And like I said, or if a coach has a specific violation, we look, okay, how could we make that better? Or this piece of paperwork seems to be falling through the cracks or not getting done in a timely manner. How can we make things better? So I would say throughout the year, we're kind of a constant checks and balances of how we can be more thoughtful, but also to how we can be more effective as well.
Okay, great. Thank you. Trustee McMahon.
Yeah, unless the auditor changed names, you've actually changed auditors since last year. Could you describe the process you used to select the auditor?
So O'Connor and Drew was actually obtained by Withiam. So they're the same. They're essentially, it's the same firm that just got bought out by the other one, but we have used the same auditors came to campus that we've been using for the past, like the actual people that have been using, but the O'Connor and Drew was acquired by Withiam over the past year.
Thank you.
Are there any other questions? If not, thank you very much, Samantha, and have a great day.
Thank you. Appreciate your time, and good luck with the rest of your day as well.
Yep, thank you. Moving on to tab 2, the audit committee work plan for fiscal year 24. Tracy.
Thank you. Yes, and good morning, everyone. The work plan before you is an information item, and we'll go to the November board meeting also as an information item. This committee typically meets twice a year in the fall and in the spring. And as you just heard, the first item of the work plan is the Department of Athletics agreed upon procedures work. It includes both their compliance, which, as Samantha said, is done over a 4-year period, which is really good for controls to revisit a portion of that every year, that process was established decades ago. And also their annual Department of Athletics financial report, which could be delivered in the fall or the spring. And next on your work plan is receiving the UMS annual financial report, which is our audited financial statements, and Darla Reynolds, the Director of Accounting, will present that information later. And as part of that, Linda Bourneville with KMS Actuaries, owner of that company, also will be presenting information about our other post-employment benefits program, which is essentially retiree medical and that is because it's so significant to our financial statements. So she's here today as well. And then the external audit report, CLA is here, and they'll talk about any required communications or comments about the audit that they would like to make, and a discussion of emerging accounting issues. And then in the spring, we'll come back and we'll look at the single audit report, which is the federal funds report, and any issues that arose there, and receive an opinion from the auditors. The auditors will also address again their required communications and provide an update on planning for the following fiscal year's audit and any emerging accounting issues. And Orno, Athletics will come back again if there are reports to present for financial or compliance reasons. The other item which we did remove from this year's work plan is enterprise risk management. And that is just pushed off to next year, given that Nate Anaya has just come on board and he's been here about a year. So a month. So he needs to get this area, comfortable with that, and we'll come back to you. So I think that's pretty much it. Happy to take any questions.
Great, thank you, Tracy. Trustee McCarthy.
Thank you, Tracy. I think you answered the question I was going to ask, but around enterprise risk management, and I know you said that getting your hands around it, but in your mind, does that include like cybersecurity and like other like maybe federal types of compliance, et cetera? It would be good to just get a flavor of what you think about in that bucket. And I think it's important that we do take it up in the future, but understand you're just getting up to, just kind of getting up to speed.
Yes, and thank you. And I don't see Gretchen on the call, but it absolutely includes all assessed risk. Go through an effort to look at all areas, whether it's compliance, financial, cyber, everything. It's an enterprise-wide risk program. And each committee of the board typically receives some sort of information from Gretchen. It's been a while since I've been involved with that, decades in fact, but the idea is to identify the strategic issues for the institution and help mitigate those with controls.
Okay, thank you.
You're welcome.
Any other questions? Not seeing none. Thank you very much, Tracy. Appreciate it.
Thank you.
Moving on to tab 3 of the post-employment benefits. That's presented by Linda.
Good morning. My video has been blocked. Kayla says, I promise you I'm not, there we go. Thank you. Good morning, and thanks so much for having me here this morning to present our annual OPEB valuation results and kind of give you a flavor of what this means and how it impacts financial statements and all of that. I'm going to share my screen with a presentation that we've prepared. And are you all able to see that?
Not yet.
Okay, it is thinking. Hold on. There we go.
Yes.
Are you seeing the presentation mode or the PowerPoint? Because
PowerPoint mode.
All right, here we go. How about
There you
that?
are.
Right.
Okay. So just a short introduction. My name is Linda Bourneval. I am the owner of KMS Actuaries. We've been in business for about a dozen years. We work predominantly with public sector entities such as University of Maine System, mostly in pensions and OPEB. I am a pension actuary by, education and experience, but it's sort of a natural transition that pension actuaries actually perform OPEB valuations because the concept's the same, the benefits are different. By way of our agenda, we're going to talk a little bit about why we do this valuation every other year, what our model kind of entails. We'll talk about the UMS OPEB Trust, and I'll provide you some key results that occurred in 2023, where we kind of now land in our funded status and how these results appear on your financial statements, those disclosures, and it'll provide you some resources for any of those who would like further information. I want to start out by thanking Tracy Elliott and her staff. There's a lot of information that we need to get this valuation compiled, not only just member data and retiree data and all kinds of things. We're looking at health insurance information, background on programs you have in place, all the financial pieces, kind of the ins and the outs of the entire thing. And her staff, including Darla, Leslie, and Janice, are very responsive and help us do our job so much better. So I just wanted a little shout out there to thank them for making our job a little easier. So what do? We do a periodic review of the OPEB plan experience. And what that means is every other year, we perform what's called a full valuation. And this was a full valuation year. That means we actually collect huge files of every retiree, any dependents that they may be covering, and what their health insurance elections are, and other demographic data that's related to those retirees. We collect information on every active employee who may be potentially eligible for OPEB, because that's what we're trying to kind of predict. We're trying to forecast what we think will happen in the future based on the benefits available to your future retirees, which are your current actives. OPEB, what we value is other post-employment benefits. And all that means, the GASB came up with this term many, many years ago. It's benefits provided to retirees that generally include, medical, health insurance coverage, dental coverage, vision, that kind of thing. The other really is that group of benefits that is not a pension plan. So the traditional thought of, I work so many years, I have a certain salary, I might be, offered a defined benefit pension plan. It is not that. It's all the other stuff. So yeah, there was kind of an interesting, other post-employment benefits. So what we're going to do is we're going to look at the liabilities, calculate those liabilities based on all that member data that I just talked about every other year. And we will collect information on the assets or what the dollars are set aside in the OPEB trust. A very important part of our model is to review our assumptions and our methods every single year. We want to make sure that those assumptions are appropriate, that they're consistent with each other. And they are reasonable, and very importantly, that they conform to the actuarial standards of practice. That's basically the profession's kind of cookbooks of standards that we are to follow to kind of give the public assurance that we sort of aren't just, willy-nilly kind of assigning some of these assumptions to our model, that we are selecting assumptions that fall into this appropriate, consistent, and reasonable. We develop contributions that are based on the UMS's funding policy to contribute to the OPEB trust. And then with all of the results from our model, we develop financial statement disclosures. Because OPEB is a pretty material item on the financial statements, that's one of the pieces that we do. For this particular year and two priors, we have reflected the HRA exchange program for Medicare eligible retirees. And then, of course, we want to recognize the asset value as of the measurement date. That's a very volatile item. It's based on market value of the trust. So every June 30th, we are looking at that. Okay, so our model, as I already mentioned, is made up of, we look at all of the member data, an employee, how old are they? How many years of service do they have? When do we think they're going to retire? Will they just leave the University of Maine system and never collect a benefit? Will they become disabled? All of those things are put into the model. We look at the substantive plan, which is the kind of the cookbook again of the benefit provisions. What do you offer? If you're an early retiree, meaning you're not yet eligible for Medicare, there is a benefit that is available for you to select. If you are eligible for Medicare, You can either select the Audit HRA exchange, or you can be covered under a traditional Aetna Medicare Advantage plan. So those are the plan, simplified plan provisions that are available. And then we apply all of these assumptions. We're trying to, predict into the future what we think will be paid from this program. And all of that comes out some liabilities. And from those, we develop some results for funding and the accounting disclosures. And as I mentioned before, 2023 valuation, June 30, 2023 was a full valuation. And that just means we actually used real census data as of that date, as opposed to a roll forward, which we'll be doing next year. And that is, that's just kind of taking our calculator and rolling forward the liabilities to develop these disclosures. So the member data as of this valuation, we had a little over 4,000 active employees who would be potentially eligible for OPEB. And we need key data elements, as I mentioned. We need to know how old people are and how many years of service that they have and their gender and what health coverage they actually have now as an active employee. Doesn't necessarily mean it's going to be the health insurance they're going to select as a retiree, but it gives us an idea of sort of patterns and what people might be electing. We also have almost 2,300 retirees and survivors and about 900 covered spouses that are currently receiving some kind of benefit under the OPEB program. Their key data elements very similar to the actives, their age, their gender, and what health coverage they have. So the plan provisions, as I mentioned, OPEB is other post-employment benefits. We've got mainly medical coverage, health insurance coverage. There's a small grandfathered group of life insurance retirees that is literally so insignificant to the big numbers here. There's just a handful, literally, like I think 12 people. I already mentioned that the Medicare eligible retirees and their spouses can choose between the Aetna Medicare Advantage plan, and effective January 1 of 2021, they also could elect may elect coverage under the Audit Retiree Health Exchange program. Early retirees and spouses, as I mentioned, are able to elect the plans that are currently available to active employees. So those, that benefit, if you are retiring prior to age 65, literally is kind of a continuation of your coverage. For this year, FY 2023 and FY 2024, there was a special retirement plan offered to employees where 137 of them retired or will retire under this program. The program provided a special incentive benefit as well as continued health insurance at the active rate for the early retirees. So we kind of need to look at that. We need to say there's a program here that kind of incentivizes people to retire. So it modifies an OPEB liability, because without this program, they probably would not have retired. So we needed to quantify what this event meant to the program. And I'll talk a little bit about, what that quantification actually came out to. All the plan details, there's, pages of them are in our actuarial valuation, and we summarize them all in our plan provisions. All right, as I mentioned, the actuary's job, and this is our most important role here, is to select assumptions for this model. And the most important assumption is the discount rate. That is the rate, two pieces. One, it's the rate that we discount our future projected benefit payments to the present. And it also is the rate that we think, or the investment return rate that we anticipate will be applied to your OPEB trust. We look to NEPC, the University of Maine Systems investment consultant. They provide their long-term expectation of future their future expected return on the entire portfolio. So they work with the system to come up with an investment policy for this benefit, keeping in mind, this is a very long-term benefit, right? We're not looking to use the resources of this trust, in the next year or two. We are looking for over, decades, many, many years, because we're projecting benefits to be paid out for a 25-year-old who's working now, who will obviously retire, 40 or 45 years from now and live another 20 years. So this is a very long-term expectation. We have been using a 7.25% discount and or a long-term investment return rate. And that's in alignment with NEPC's projections as well. There's a lot of other assumptions that are applied. I mean, for each individual employee, there's probably millions of calculations that occur for each person. But these are the key ones: are healthcare trend rates. How do we think healthcare costs are going to increase year over year in the future? We've got a few different things going on here. We've got the Cigna plans, which are a little bit different than the Aetna and Medicare Advantage plan. So we kind of look at those two pieces separately and apply certain trend rates to them. There's also a catastrophic drug program under the HRA exchange that we look at separately as well and apply trends to that. The demographic assumptions are not as impact-filled, but they still are assumptions. Mortality rates and mortality improvement rates. How long do we think people are going to live is a huge component of this model, because as long as people live, the benefits will be provided. So selecting mortality tables that are in line with, our expectations is very important. Other pre-retirement decrements, that just means as an active employee, what could possibly happen to me as an employee going forward? I could terminate and never have a benefit. I could retire at some age. Well, if I retire at 60, maybe instead of 70, that's very meaningful for the model, because I will be receiving 10 more years of benefits than if I retired at 70. And will I become disabled? That could mean I'm going to be on a retiree, health plan for many more years than I would have if I just simply retired. So the OPEB trust, UMS established the OPEB trust. Actually, the effective date is tomorrow, 2008. So it's 15 years old at this point. And since then, UMS has contributed consistently to accumulate assets to pre-fund these liabilities. The GASB requires certain criteria in order for us to recognize that trust or those assets in the financial statements. And there's basically 3 criteria that must be met. The assets that we set aside must be dedicated to providing these benefits, OPEB benefits to retirees. The assets must be legally protected from creditors of the employer, and the employer contributions and the interest earned on them must be irrevocable. That kind of means, once in, can't take them out for other reasons, for any other reason than to provide benefits for retirees. So it's pretty strict, coverage of the criteria that must be met in order to recognize those. Every year we review the funding policy that UMS has developed, and that is kind of the nuts and bolts of how do we fund this trust? Under what conditions do we put money in? Under what conditions can we take money out? That policy is very specific for that criteria. The policy is reviewed annually to make sure that it addresses all kind of components that might come up that might be unanticipated at one time or another. So that's important when you have a written funding policy on establishing that OPEB trust and its growth. What are the benefits to pre-funding? Some people might say, we'll just continue doing pay as you go. We'll just pay the insurance companies. We'll just pay the claims if we're self-insured. But the benefits to funding you do get to set aside, kind of like a pension plan concept, right? You're setting aside money in the infancy of the program in order to pay out benefits later on when these benefits might be pretty expensive. But the real benefit, at least on your financial statements, is that you get to use a higher discount rate. On the extreme opposite end of the spectrum of zero assets set aside, we are required to use a high quality municipal bond rate. And right now, if on June 30th of 2023, we were needing to use that municipal bond rate, we'd be looking at a discount rate of about 3.65. So you can tell the difference between that versus 7.25 is a very significant difference in how we would value these liabilities. So because there are enough assets set aside technically to fund all future payments, including a funding policy that will make sure the assets never run out, right? We get to say, let's discount all of our benefits in the future with the long-term rate of return. If you had no assets, you'd have nothing set aside. You'd need to basically borrow money under that high quality municipal bond rate. And that's why you'd be forced to use that bond rate instead. As I mentioned about the funding policy, we review it every year with UMS, and if any, anything needs to be tweaked or kind of more fine-tuned, we will revise it. And it was most recently revised about a year ago. Not going to go over all the numbers on this slide, but this just kind of gives you a feel for where the numbers here are falling. The OPEB trust, beginning of the year was about 156 million, ending balance about 174 million. We did have a pretty robust return this year compared to, say, last year in June of 22, as we know the market was not strong and it did rebound quite a bit. We had over almost a 10.5% return. Remember, we're expecting 7.25, so we had a gain over what we anticipated. On the right columns, our total OPEB liability generally grows every year with new benefits being anticipated, just kind of like it's just time value of money that generally OPEB liabilities tend to increase. We did have a pretty significant experience gain this year, and that was mainly attributed to the Aetna Medicare Advantage program. That really has held kind of steady, and our healthcare trend rate assumptions have not proven out as close as we'd like them to. So we did have an assumption change there to kind of anticipate what we're hoping to be a little bit closer to how we think that Aetna program is, growing in the future. And that's still to be monitored. We watch it every, again, we review all the assumptions every year. So our liability actually dropped by about $20 million from the beginning of the year to the end of the year. At this point, there is a net OPEB asset on the book. So that means that the assets at this point in the trust exceed liabilities. And that is about $21 million of a net OPEB asset. This chart kind of gives really shows the volatility of the program. And really the volatility comes with the assets. The group of people that generate the liability, the plan benefits, as you can see from 2016 to 2020, and that's in the dark green bars, that's pretty consistent from year to year. The people is, you're not all of a sudden going to cut your retiree group in half or your active employee base in half. So that's going to stay pretty consistent. Where it didn't stay consistent was between 2020 and 2021. That was implementation of the HRA exchange. But then from this point, that green bar, as long as everything, all else stays the same, is going to stay pretty consistent. What really doesn't stay consistent is the market value of assets. And that's the pale green bar. And you can just see how it's pretty volatile, at least from 2021, where we were fully funded, actually a little overfunded. Market value, June 30, 2022, the market was pretty weak during that time. So, here we're showing market value, and that's really going to be the volatility of this program is in the assets. So as I said, from the last 3 years, you can kind of see what's happening. We were in surplus, then we dropped below surplus and had a liability, and we're back up to, some surplus. So, NEPC will continue to monitor that and offer suggestions on possible changes to the investment policy on kind of keeping that, that risk, out, kind of contain that risk. So the financial statement disclosures, we take the results of this valuation model, and we calculate items that are going to appear on your financial statements. As I already mentioned, there is, as of June 30, 2023, a net OPEB asset, and that's the assets minus liabilities, in this case of about $21 million. We also calculate an expense under GASB 75, and that's, by the way, one of the standards that is OPEB, the other is GASB 74. As of June 30th, it's about $3.2 million. That's generally the change in the net OPEB liability from year to year. There are some deferrals that are incorporated into that. There are some other items that need to be recognized immediately, like a benefit change. That occurred 2 years ago with the implementation of the HRA exchange. But items that can be deferred into in the future for a few years are experience gains and losses, kind of out of the control of the plan sponsor. The assumption changes, again, those can be, some of them can be deferred, and then investment gains and losses on the OPEB trust can be deferred for 5 years. The reason that the benefit changes are recognized immediately is the concept that those are under direct control of the plan sponsor, so they become recognizable immediately. As I mentioned before, we have a full valuation report that memorializes all the assumptions that were used, all the methods that we use, all the data stats and plan provisions and everything that kind of is the backup to all of these results. We actually dated it October 4th, but yesterday we provided a revised report. So technically it's dated October 26th. So that, for any additional information you might need to find on the disclosures, are provided there. We refer everything to, by the GASB, the statement, the standards. GASB 74 and 75 are the controlling standards here on the work that we do. And we are the actuaries for the University of Maine system. So I'd be happy to take any questions anyone might have.
Thank you very much, Linda. This is a great presentation and a good result. So could you pull down your screen so you can see everyone? Thank you. The one question I have, is there a limit on how much assets that you can have in the system? I mean, right now it's what, 21 million. Is there a certain percentage that we shouldn't go over?
The funding policy kind of controls that so we have what's called the annual actuarially determined contribution, the ADEC, right? We're going to calculate an ADEC based on where the funded status is right now. So there is some control over that. I guess what we can't control is whether the assets are going to really, work for us and, the market takes off. So that can be the time when UMS starts using the trust to pay the benefits instead of paying them out of the general fund anyway. So there is no, if you want to be 200% funded, you could be, but there's some controls in place in the funding policy that will kind of keep that at bay, that you could start taking out, withdrawing from the trust to pay the benefits, and not contributing to the trust to add more principal.
Great, thank you. Are there any questions?
Mr. Chair, could I ask you a question?
Yes.
I wonder if Linda or CLA or Tracy, how does the 114% compare to other higher eds? I feel like I feel like when I've looked at financial statements from others, I feel like we're an outlier there in a positive way. We're often an outlier in the other way, but it feels like we're in a really good spot. That's certainly my experience when I was in state government. So just interested in if there are any comparisons out there in higher education.
Hi, this is Mike Johns from CLA. I agree with that statement, Ryan, that you are above the average. You know, it's not always comparing apples to apples because a lot of public universities participate in state multi-employer plans where you have the single employer plan, so you basically have control over how well funded or not. But you know, I was looking the other day, just going down, starting at Maine and going south down New England, and looking at other state systems of higher education. And, you know, to your immediate south, there's two with single employer plans that are unfunded. So they have that no assets set aside in the trust. And, you know, when you go looking at those state plans, that the multi-employer plans that systems participate in, again, looking in the general mid-Atlantic, New England area, it's anywhere from 10% funded to 175% in an extreme example where one system took out debt to fund their portion of the state plan. So it's all over the board, but I would agree that you are an outlier in terms of being well funded in that plan.
And I would kind of echo that comment, Michael. We work on a lot of OPEB plans, mostly for, you know, many other small to mid-sized municipal entities. And I would say maybe the average might be 10% funded. People really, when GASB 74, 75 kind of came into play, said, oh, we can fund something, you know, and you guys have been doing it for many, many years. You are well ahead of the curve. And I think that is the difference, that you really started earlier. Everybody else is kind of playing catch up, and there just are very few entities that we work on that have, you know, significant assets.
Trustee McCarthy.
Thank you, Chair. On the discount rate, given it's an important lever, how does the 7.25 compare to where it had landed previously in previous analyses, Linda?
We've been at 7.25 for a few years now. We might have been at 7.5. I don't have that right in front of me, but Tracy, sorry.
I'm sorry. Yes, we were at 7.5. It was modified down a number of years ago.
Yeah. So that has been the pressure. I mean, you know, we are probably, you know, if we did this work well before 2017, we probably would have been in the 8s. Same on pension plans, right? Same concept, same long-term outlook. There's been a lot of pressure to reduce that down to, you know, in the low 7s. There are many pension systems at this point now, probably below 7. I think staying at around the low 7 mark is probably okay for the next cycle even. But again, we look at that every year, and we look to NEPC, and we look to a bunch of capital market expectation surveys to kind of get that comfort, because that is a very important assumption that, you know, it's not going to be right? It's an assumption. We're just kind of hoping that that it's realistic and, you know, doesn't put too much pressure if we start reducing it too much, because lower discount rate means higher liabilities. Right. And that, you know, that could be another reason. That probably in that chart that we had that had the, you know, the different liabilities, there's probably a change in there from that 7.5 to 7.25. That would have been an upswing.
Great. Thank you. So it's a conservative compared to other comparables also, is what I'm hearing, which is a good way to
it's supposed to be a long-term expectation. Some investment consultants don't wrap their head around that idea, and they want to kind of look at the next 5 years, but this is just not a short-term, you know, obligation. This is very long-term. I mean, you've had the trust for 15 years at this point. You know, we're hoping it's going to be here for another, you know, 55 years, you know.
Thank you.
Any other questions?
I'm sorry.
Tracy?
I would just add to that, the trust is invested in the managed investment pool, and Ryan reports on that pool and its performance every board meeting. So just to give context of the portfolio that holds these assets, it's part of that pool. And I would just also add regarding where we stand relative to our peers, and wanted to note way back in 2008, we did a valuation when this standard came on. And the plan at that time assessed in over a $330 million liability. So it was actually a great thing that the standard came in, because it made us take a hard look at our plan and made some modifications at that time, which really helped set us up for being able to fund by addressing the concern and the liability at the time.
Great. Thank you, Tracy. Any other questions or comments? If not, I mean, this is good news. So glad to see that we're above other university on this particular issue. So great job, everyone. Appreciate it. And thank you very much, Linda. Appreciate it. Moving on to item tab number 4, the annual financial report, and that's going to be presented by Darla.
Good morning, everyone. I'm pleased to present the FY23 annual report today. This is located in tab 4.1 of your materials. And note that the report is actually in draft form, awaiting board approval later today. So it is an action item for this committee to move it to the board meeting. And for ease of discussion, however, I'll speak from the PowerPoint document that's located in tab 4.2. And if you bear with me, I will share my screen. So hopefully you can all see the title page of the report. Before we get started, though, I'd like to thank various groups of people, including our auditors and all of the campus and system personnel who responded to our many data requests. A lot of time and energy goes into the audit itself and preparing the financial statements each year. And there are lots of requests for data, and those often come at what are very busy times for the people involved. So thank you all for making the requests a priority and helping us get to this point. I also want to thank my staff for their efforts in getting us to this point. And I want to especially thank Janice Elsmore. She's the Assistant Director of Accounting, and she led the audit this year from the system side and prepared the bulk of the financial statements. And she's been doing that, I think, since at least 2008 or 2009. So thank you, Janice. So moving to page 2 of the PowerPoint, there are several discussion items shown here, but we'll spend most of the time on slides 7 through 13, which address the financial results and the financial position of the university system. Over on page 3, you see the 3 sets of financial statements required to be included in the annual report. Each set represents a separate unit upon which the auditors provide an opinion. And the first set covers the university system itself. The second set covers the University of Maine Foundation as a component unit. And finally, the third set covers assets the system holds for other entities in a trustee or fiduciary capacity. Before we jump into the financial statements, though, I'd like to address or speak briefly about the independent auditor's report. This report is still in draft status, but we're happy to say that the opinion is unmodified, or what we've always called a clean opinion, and is pending final review by the auditor's quality review team. And I imagine Mike may mention more about this during CLA's presentation a little later. Now here on slide 5, we see that there were several new items for FY23. It was a busy year for the accounting department. We had new debt of $158 million from the issuance of 2 revenue bonds, and another $11 million borrowed through the system's master lease purchase agreement for an energy services contract at, that one was at Farmington. And during FY '23, we also implemented 2 accounting standards, which resulted in a small restatement of FY '22 results in the June 30, 2022 net position balance. We also restated the FY '22 statement of net position to include new assets and related liabilities. And I'll just make a brief comment about each of these new accounting standards. First, GASB 94 really had minimal impact on the financial statements this year, but we're expecting a greater impact in FY '24. UMaine's contract with a third party for renovation of 2 buildings to create and operate a boutique hotel space. That's a public-private partnership or P3 agreement that is subject to GASB 94. And under that accounting standard, certain events must occur before we can record anything in the financial statements. And although the UMaine contract was signed in early FY '23, the necessary events had not occurred as of June 30. Thus, the financial statements only include note disclosure about the contract. Next year, we're expecting to have assets and liabilities related to it. Now, GASB 96, also implemented this year, is the second standard GASB has issued addressing what they term right of use assets. That is, assets that belong to another entity, but for which we have exclusive use for a set period of time. Last year, as you may recall, we implemented GASB 87 for leased assets. And now this new GASB 96 addresses certain subscription-based information technology arrangements, what we call SBITs for short, because that's much easier to say, such as software as a service. And pursuant to this standard, we must record an asset and a liability for these types of contracts. Now, over on page 6, this shows the financial statements impacted, or excuse me, the financial statement lines impacted by the OPEB plan. As Linda mentioned earlier, at June 30th, 2023, we had a net OPEB asset of $21 million compared with a net liability of $18 million the prior year. It was included in this accrued liabilities line. We can see that this large swing of 39 million, however, had very little impact on current year net position, just $3.2 million. And this is because, as Linda mentioned, certain differences between expected and actual results are amortized over a period of time. And the unamortized balances of those changes are sitting in this statement of net position in the deferred outflows or the deferred inflows line of resources. Now, turning now to page 7, you see a portion of the system statements of revenues, expenses, and changes in net position, or what we call the SHRECNIP for short. And as required by accounting standards, we presented the system's revenue and expenses by 4 categories. The operating revenues and operating expenses you see here on this page, and also non-operating revenues and other changes in net position, which you'll see on an upcoming slide. Now, going to the subtotals on this page, you see total operating revenues of 464 million, less total operating expenses of 810 million, for an operating loss for FY '23 of $346 million. And I'll emphasize again this year, as I've done in the past, that the system's operating expenses are always going to exceed operating revenues, as GASB requires several revenues that the system uses to fund operations to be reported as non-operating. And you'll see those a little bit later on page 9. Now, moving back to the top of the page and looking at operating revenues, you see that there was a slight decrease from the prior year, with revenues such as grants and contracts, recovery of indirect costs, and educational sales and services offsetting almost all of the decrease in net student fees. Looking at operating expenses, which again totaled 810 million for FY '23. They're basically flat compared with the prior year. Now, given that student aid, which is this line right here, that had a $30 million decrease due to a decrease in coronavirus relief funding that we were receiving for that purpose, one might ask why operating expenses remain flat in total. So when we exclude this student aid line from total operating expenses for both fiscal years, we find that the total for all other operating expenses increased $30 million or 3.9% from FY '22 to FY '23. A few of the material drivers in this increase are increased grant activity. So as we spend $1, we get $1. So it's a net wash as far as this line is concerned, but it does cause an increase in operating expenses. There are also one-time costs associated with campus and system strategic decisions, expenditure of restricted gifts, which fluctuates based on timing of when we receive those gifts and the purpose for which they may be used, negotiated across the board compensation increases, and also inflation. And before we move away from this page, I just want to make a comment about this decrease that you see in instruction expense. This line of instruction expense includes the expense associated with the special retirement incentive that was offered to the faculty in FY '22 as phase 1 and in FY '23 as phase 2. The first phase expense was higher than the expense for the second phase, as a greater number of faculty made the election during phase 1, and the benefit for phase 1 was greater. So with that, I'll move to page 8. Just look at this page quickly, just to say that it's the same $810 million in operating expenses, just presented on a natural classification. And I'll move on. To page 9, and at the top, you see here that we start with the same operating loss of $346 million that we saw at the bottom of page 7. And here under non-operating revenues, this is where you see the various revenues that are crucial to supporting the system's operations, but that can't be reported as operating revenues. Certainly non-capital state of Maine appropriation, we definitely rely on, and the federal Pell grants and the investment income in particular, as well as endowment return. So if you take those revenues and offset them against the operating loss, you see that the system experienced a loss before other changes in net position of $23 million for FY '23. And that's an increased loss compared with the nearly $10 million loss the prior year. Now, looking at some of the lines in this net operating revenues section, I'd like to provide some context around this $60 million decrease in coronavirus funding and its correlation to operating expenses. Now, as mentioned earlier, the $30 million decrease in student aid expense is directly related to this decrease in funding on this line. The remaining $30 million decrease in this line, however, does not necessarily have a direct correlation to operating expenses for two primary reasons. First, a portion of the coronavirus relief revenue that we recognized in FY '22, the $63 million, related to an estimate of lost revenues rather than to actual operating expenses. And the second reason is because of the way that accounting standards required that the coronavirus relief funding be recognized. You may recall me mentioning in the past that revenue recognition for the institutional portion of the federal HERF dollars was limited each year to a percentage of the amount that had been spent from the student portion. And consequently, a portion of this $63 million that we recognized last year is actually related to expenses and or lost revenues from FY21. Now, looking at the other revenue lines under non-operating, there's good news related to because we see increases in the non-capital state of Maine appropriation and the investment income lines for a combined increase of nearly $46 million. We'll remain on this page, but now we'll drop down and look at other changes in net position, which totaled nearly 55 million. Whoops. Sorry about that. Which totaled nearly $55 million for FY23, and that was up 19 million from the prior year. Now, revenues in this section, they support additions to assets and endowments and the reduction of debt, items that you'd see on the statement of net position rather than here on the SHRECnet. And revenues in this section tend to fluctuate significantly from year to year. State of Maine capital appropriations and capital grants and gifts in particular are dependent on the availability of funding and the timing of our expenditure of those funds. And of course, endowment return, which is also in this section, is dependent on market performance, which we've seen fluctuate significantly over recent years. And finally, moving down towards the bottom of the page, we see this line change in net position and see that the system's net position for FY23 increased $31.4 million. And that's up from the 26 million that we experienced last year. And in a few moments, we'll see how this $31.4 million actually flows over to the statement of net position. And with that, I will turn to the statement of net position. And on this first page, we see the assets and deferred outflows of resources. And at June 30, 2023, the system had good liquidity with $265 million in these two lines of cash and operating investments. And these two items account for 76% of the system's total current assets at that same date. And during FY23, the system experienced $13 million of positive investment returns from these assets. Looking at the two lines, though, you see that they did decrease from the prior year as the system used investment proceeds for a variety of strategic and required purposes, including the following, to name just a few. Approximately $33 million of unrestricted monies were used for capital construction. And we made payments to reduce various liabilities, including a reduction of long-term debt in the amount of $9 million. We paid $10 million for a Social Security tax liability that had been deferred during the course of the pandemic. The Internal Revenue Service had said you could delay payment of the employer portion. So we had made that election, but the amount that had been deferred had to be paid in full by December 31st, 2022, and we met that deadline. And we also paid out $4 million towards the special retirement incentive offered to faculty. Now, moving down the page to non-current assets, we see that they totaled almost $1.2 billion at the end of FY23, and that's up 168 million from the prior year. And I'll make just 3 points related to non-current assets. First is this line deposits with trustees that you see a $23 million increase. And this relates to unspent proceeds from the new debt that I mentioned back on slide 5. And this balance will, of course, decline as campuses complete their finance projects. Second is the net OPEB asset that Linda mentioned. You see that here under non-current assets. And finally, capital assets. You see that those increased $122 million from the prior year. Now, this is the largest net increase in capital assets in the 5 years ended FY23. The next largest increase was $98 million last year. Now, the FY 23 increase represents $175 million of new capital investments, less an increase in accumulated depreciation of $50 million and disposal of assets with a book value of $3 million. And as you may recall from last year, accounting standards now require that leased assets be recognized in the statement of net position. And of course, I mentioned that this year we have to bring on the software contracts. So included in that $175 million gross increase in capital assets is actually $24 million of new leased assets and $2 million of new subscription-based IT arrangements. And within that $24 million of new leased assets is the custom house property that we acquired as a lease late in the fiscal year. Now, moving down the page, we see deferred outflows of resources, which decreased nearly $15 million. That's related to the OPEB plan and that $39 million swing that we mentioned earlier. Oops, I've lost my place. Anyway, so we'll turn over to the next slide and look at liabilities, deferred inflows of resources, and net position. And as you can see, total liabilities were $469 million, up $64 million from the prior year. Not unexpected given the amount of debt that we acquired this year. And I want to make a comment just on two liability lines. First is this accrued liabilities current portion, which decreased nearly $19 million. And that's primarily because of that reduction in liability for Social Security taxes and the retirement incentive payments that I mentioned just a moment ago, in the discussion of why operating investments went down. And also looking at non-current liabilities, we see that the non-current portion of accrued liabilities right here, this $20 million decrease. If you remember from slide 6, that decrease is primarily related to the OPEB plan. Now, moving slightly down the page, we see the deferred inflows of resources with an increase of $21 million, again, related to the OPEB plan. And finally, now looking at the net position section of this page and looking at the variance column, we see the $31.4 million increase in net position that we saw at the bottom of the SHRECNIP several slides ago. And as you can see, there are 4 categories of net position. I'm not going to go into the description of these. I'll point out that you can find these descriptions on pages 50 and 51 of the annual report that's in tab 4.1. But I will elaborate on 2 net position categories with significant changes. First is this $45 million increase in net investment in capital assets. I'd point out that this differs from the $122 million increase in net capital assets that we discussed under non-current assets, because that increase is offset by an increase in related debt to arrive at the net position associated with those assets. And also capital assets funded from non-debt sources such as restricted or unrestricted net position would be reflected in this $45 million change. Now, the second item I want to talk about is unrestricted net position. This category is not subject to externally imposed stipulations. However, these resources are critical for the financial stability of the system and have been designated by management for specific purposes, and those purposes are noted on page 12. I'm not going to turn to page 12, but at the end of the presentation, I'll address any questions you may have about those. And this decline in unrestricted net position, this $19 million decrease, is the net of multiple items, including the return on unrestricted operations, payment of principal on long-term debt, and investment in capital assets, to name just a few. And as I mentioned in our discussion of operating investments, the system had utilized approximately $33 million of unrestricted funds to invest in capital assets. And the final note I'll make on this section, that as we use either restricted expendable net position or unrestricted net positions for things like investment in capital assets or to pay off debt, there is, of course, a reduction in those lines for that type of thing. However, it's basically a shift from those lines to a net investment in capital assets. So as you see, these two lines decrease for those purposes. You'll see an increase in net investment in capital assets rather than a reduction of total net position, because basically you're exchanging the asset you have. You're exchanging cash for a building, basically. So it just all rolls through this section. Now moving to page 12. Whoops, that's the breakdown that I was talking about. And then moving over to, sorry, I can't seem to get my cursor under control. Statements of fiduciary net position you see on slide 13. Again, this relates to assets that the system holds for other entities. I'm not going to spend any time on this. And then over on slide 14, you see the statement of changes in fiduciary net position, just showing how we got from beginning of the year balance to end of the year balance. It's kind of like our SHRECNIP, but organized in different categories. And with that, that concludes my remarks, and I'd be happy to take any questions you have.
Thank you very much, Dalla, for that very enlightening report. So appreciate it. Are there any questions from the trustees or anyone else? Trustee McMahon.
Darla, a great report. Just one quick question. I see that current liabilities, accounts payable, are down $5 million. So we're paying our bills promptly. Are we getting a discount on our bills by paying promptly? Did we earn anything by dropping our accounts payable by $5 million?
Yeah, well, some of that is us trying to take advantage of any discounts that the vendors do offer. And there are vendors that do offer the discounts. I can't speak to the details because it really isn't my area. But in some of it, when you see the swings from one year to the other, it's timing of when that final check run is. We cut checks and pay our bills on Tuesdays and Fridays. So that factors in from year to year as well. That sometimes you can see it pop up if, the last check cycle was on, or the year ended just prior to a check cycle, then you might see the liability for accounts payable be higher that year than in a subsequent year where we can get one more check run into the fiscal year. But yes, we do, as I mentioned, there are vendors that we have that offer discounts for early payment, and those are built into the procurement system.
It's just, a $5 million swing is a significant swing.
Yes, and like I said, the timing, because at that time of year, we're getting a lot of bills in for construction, so it could take only 2 invoices, timing difference to make up that type of ground.
I'm also happy to get, I can follow up with Gretchen. We can get a little bit more information on that for you as well, Trustee McMahon, and report on that maybe at the part of the board meeting.
Thank you, Ryan. Any other questions, Trustee McMahon? Is there anyone else have any questions? Not seeing none. Once again, I want to thank you, Dalla, you and your team for putting this together. It's a lot of work, and you've done a great job. So thank you very much.
Thank you, and you're most welcome.
Moving on, I'll read the text of the resolution. that the audit committee forward this item to the October 27th, 2023 special Board of Trustees meeting for approval of the following resolution. That the Board of Trustees accept the recommendation of the audit committee and approve the fiscal year 2023 annual financial report as presented. Are there any discussions or questions?
So moved.
It's been moved by trustee Martin. Is there a second?
Second.
Second by trustee McMahon. Kayla, will you take the roll call?
Trustee Mishu,
Yes.
trustee McMahon,
Yes.
trustee McCarthy,
Yes.
trustee Martin,
Yes.
and trustee Riley.
Yes.
The motion carries.
Thank you very much. Moving on to the last item, tab number 5, auditor's communication to the audit committee. Mike and Andy, I guess, will be giving that presentation. Mike, I'll turn it over to you.
Thank you. And thank you for having us. We have a slide deck that I'm going to attempt to share. And one of these times I'm going to have to negotiate with Darla because, you know, she steals some of my thunder with the presentation. So maybe one of these years I'll have to go before Darla goes. But can you see the slide deck? Okay.
Yes.
So what are we going to go over today? We're going to go over the financial statement audit for the year ended June 30, 2023, and talk a little bit about what we're engaged to do, the scope of what an audit entails. We're going to talk about our required communications that the auditing standards state that we need to go over with governance, internal control communications, and the next steps to finalize this year's audit and meet that deadline. And I'll end up with some very brief high-level comments on what we're seeing as we serve as institutions of higher education across the country. So what do? We're engaged to express an opinion on the financial statements for the fiscal year I noted. Management's responsible for preparing those statements and making sure that there's internal controls in place to prevent and detect any material errors. Our job then is, once management performs their work, to come in and perform tests, samples, various other procedures to enable us to express an opinion on those financial statements. As it relates to internal controls, we gain an understanding of those controls. We walk through the key control cycles, most notably cash disbursements, cash receipts, and related revenue and expenses. And in some cases, we do perform a test of operating effectiveness and internal controls. However, the purpose of those procedures are for our risk-based audit approach, so we can properly plan and perform the audit. We do not express an opinion on the internal controls, and that doesn't occur in any financial statement audit outside of the Sarbanes-Oxley or public company world. We're required to perform our audit in accordance with our professional standards, which includes generally accepted auditing standards and also includes government auditing standards. That's a requirement because of the federal grants that the system receives. The financial statements are prepared under generally accepted accounting principles in the United States of America. So some other terms of the engagements, we do have those required communications, and I have a whole slide on that to report to this group. And I talked about the internal controls. So I'll move along to the next slide. So what is a risk-based audit? We're required at the beginning and throughout the whole audit process to assess risk, that if something were to go wrong, where are those risks, whether due to mistake or error or fraud? Where is there a chance that the financial statements could be materially misstated? We perform that risk assessment by gaining an understanding of any changes at the system through conversations with management and various planning procedures we do. We also look at the external factors such as the current state of the economy, any industry trends, higher education trends. And then after that risk assessment is initially performed, then we develop our audit approach and our audit programs. And we spend more time or perform more tests where we see a higher risk that something could go wrong than those that we see less of a risk that something could go wrong. Some areas to highlight in our risk assessment the internal controls and information technology, we do bring in an IT specialist to look at the general application controls as it relates to the financial systems at the system. Revenue recognition is always a significant risk. The standards require it. The risk there is, does the revenue exist, and is it properly cut off or recorded in the correct fiscal year? Do the receivables exist, and are unearned revenues properly reflected as a liability on the statement of net position? Debt and long-term liabilities is all debt appropriately recorded at year end in the appropriate amounts? And are there any compliance attributes that needed to be covered in terms of covenants? Federal awards, talk about that in a bit related to the single audit or the compliance audit. But for the financial statement audit, again, it's really getting an understanding of where the grant proceeds recorded in the appropriate period based on usually allowable expenses that are charged to those grants. We did have 2 new accounting standards this year that Darla did a great job of going over. I will say that, when you look at the trend of what the Governmental Accounting Standards Board is looking at when these new standards are coming out, we had leases last year and SBITAs and public-private partnerships this year. The underlying theme is they don't like when there's a long-term contract where money will be potentially owed when there's not a liability on the financial statements. So a lot of these, we're recording new assets and new liabilities that didn't exist under the old rules, but that seems to be the trend of where they're going. The valuation, the fair value of investments is a risk, especially related to those alternative investments, those investments that are not actively traded on an exchange, such as the New York Stock Exchange, but that are usually get audited financial statements, and those financial statements are usually at a date that is different from the system's fiscal year end of June 30. So there's a decent amount of audit procedures and risk associated with those. Operating expenses were liabilities recorded in the appropriate period, were accounts payable and accrued liabilities complete and accurate. Significant estimates. Every financial statement contains management estimates, and we'll go over a few of the more significant ones in the next slide. And we talked you got a good report on one of the most significant estimates, which is your other post-employment benefits liability. So the results, we are going to issue an unmodified opinion, a clean opinion, the highest level of assurance any external CPA firm can provide. There is an additional paragraph in this year's audit report that just draws the user's attention to the fact that the new accounting principles were adopted, and draws the user's attention to the footnote where that is disclosed. The draft statements you have contain what we refer to as supplementary information. That's management's discussion and analysis, the tables in the back on the pension plans and the other post-employment benefit plans. Those are unaudited, and our report mentions that fact, that auditors do not express an opinion on those. We do provide some limited procedures, including comparing them to the audited financial statements and inquiries of management, and would report if we saw any issues there, but we do not express an opinion on them. I mentioned earlier that if we have any issues with the internal controls, if we identify any deficiencies, we're required to report it to governance. We have 3 levels of deficiencies in our professional standards. The most severe would be a material weakness, which is defined as either a control isn't operating or isn't in place, that in our opinion would detect a material misstatement of the financial statements. Significant deficiency is the next level down, which isn't as severe as a material weakness, but in our judgment would need to be communicated to governance. And the lowest level is what are commonly referred to as management comments, which are best practice type recommendations in the procedures we saw. We did have a couple of management comments this year. A couple of them are related to IT, which we'll go over in the executive session. And the last one is related to the preparation of bank reconciliations. That's an important internal control. And we didn't identify any errors in the preparation of those reconciliations, but we did identify that some were performed on an untimely basis. So months after the bank statement would have been received. And the recommendation there is to do them on a timely basis, just because of the inherent nature of cash. We want to make sure that all the accounts are properly reconciled to what the bank is reflecting. Those required communications that I mentioned, we had no changes in the scope of our audit from what we discussed way back in the spring in our planning communications. The estimates, so those estimates I was referring to earlier, they do contain significant assumptions. So what we do as auditors is we look at those assumptions, compare them to prior years, compare them to what we know is going on in the industry, and assess if they're reasonable. And the most significant estimates in the system's financial statements are those pension and OPEB liabilities, allowance for uncollectible receivables, compensated absences, and depreciation expense based on the estimated useful lives of the assets. And we did not identify any management bias or any other issues when we were auditing those estimates. However, we always like to report that they can change materially in the future based on external forces. We had no difficulties in working with management. They were prepared and closed in the agreed upon timeframes and always were quick with audit requests. So thank you to the team at the system for always being available and so punctual. It was a very effective and efficient audit. And the fact that we have no material weaknesses or significant deficiencies to report speaks very highly of the management team you have in place at the financial shop. We had no audit adjustments, so the trial balance we received for auditing procedures were not changed based on the auditing tests that we performed, and we had no past adjustments or immaterial adjustments to report. So what are the next steps? You have a draft report. It's not a signed report. We will need to update our subsequent events review. So since we completed our field work, we'll just have to perform some procedures to make sure nothing has happened in the meantime that would need disclosure in the financial statements. We'll have management sign a representation letter. It has 3 or 4 pages of representations, but in a nutshell is saying that the information they provided and the responses they gave to our inquiries were complete and accurate to the best of their knowledge. The single audit, that's the federal compliance audit of federal grants and contracts, has begun, and the timeframe for completion and the due date is in March of 2024, so 9 months after the end of the fiscal year. The student financial aid cluster, the work has already begun, and we're going to have to look at a couple of other major programs this year. When that work concludes, we will have a report out as to any compliance issues we identify and the opinions that we're expressing over compliance with those major federal programs. Current events in higher education at a very high level. What we're seeing when we're having these meetings and talking with management is there's enrollment pressures. I know it's well known the enrollment cliff is coming, and there are schools competing for a limited pool of resources in terms of students graduating high school. Moody's earlier this year downgraded the higher education industry, and that opinion of theirs was based really on one graph that showed that they expect that revenues will decrease or remain stagnant, and expenses are expected to increase due to inflation, employment contracts, and other matters. So that's why they downgraded the industry, and a lot of schools are just keeping an eye on their operating expenses compared to the operating revenues. Unfortunately, the bad actors are getting you better at their jobs. Cybersecurity is a hot topic, both in terms of costs of putting the controls into place to protect ourselves against any issues. It just locally from my local office, we had 2 higher education institutions that had a successful ransomware attack. So it's out there, and they're getting good at their jobs, and it's scary. As it's something as simple as a phishing email that can cause so many problems for an institution. I think I talked about it last year, but we're continuing to see increase in merger and acquisition activity, which in the past is almost a non-topic in higher education, but we're seeing public institutions acquire for-profit entities. We're seeing for-profit companies acquire non-for-profit schools to help train their employees. So there's a lot going on out there. We're seeing a lot of strategic thought around maybe there's some institutions we know may be struggling financially. Do they offer something or have capital that would benefit us? So we're seeing a lot of merger and acquisition activity. Won't go over a 30-minute presentation on the change in the auditing standards. What I will say is there are 3 new auditing standards for next year. Most significantly is they're requiring us to do more procedures as it relates to information technology controls. We already use a specialist at CLA on your engagement, but the procedures that they will be performing in future years are required to increase and provide some extra procedures. So there will be more time in evaluating those controls and working with your information technology team. Those are the end of my planned remarks. Again, thank you so much for your time. I'd be more than happy to answer any questions anyone may have.
Thank you very much, Mike. Appreciate it. I just have one question. When you look at the single audit and with the huge increase in congressional designated spending, is there any different criteria changes or issues that you have to look at now compared to before?
So every time there's a new bill, there's new rules that come out in what's called the Federal Compliance Supplement, which is our playbook we need to follow in performing the single audit. However, you need to receive those types of grants for it to come into play. And this year, anyway, we don't have any new significant grants that we're auditing as major programs. They also just revised what's called the Uniform Guidance, which are the rules that govern all grant activity. And they did not change the threshold for which programs need to be tested. They changed the threshold of what requires a single audit, which won't affect the system. It went from 750,000 to $1 million. So that's really only affecting smaller entities. But the thresholds for what grants do need to be audited has not changed.
Thank you. Are there any questions? Trustee McCarthy?
Yeah, thank you, Chair. Michael, glad to hear the clean report and that there was no areas of significant disagreement. Were there areas of debate where you were debating a certain implementation or standard and where you spent a little extra time on?
I wouldn't use the word debate. I would use the term colleagues discussing and implementing new accounting standards and coming to an agreement on the proper treatment of those. So as Darla mentioned, it really was a significant lift this year for her team to implement the SABITA standard and the PPP standard. And we had multiple conversations well before our final field work on the application of those standards, how we both read the standards and how they applied to unique situations at the system. So yes, a significant amount of time. Management is always well organized. So we did it before the audit, which is always a good thing to avoid any surprises. But no debates, more just good banter between finance professionals.
Great. No, that makes sense. The new things require like a different lens on them. So, and I appreciate the continued praise of what I also view as a good finance team. So thank you, Michael.
Thank you.
Any other questions, comments? Seeing none, thank you very much, Mike, for you and your team for working closely with the management team at the university, and really appreciate all the work. So thank you.
Thank you.
Moving on to the next items, executive session. Could I have a motion for the Board of Trustees committee meeting to go into executive session under the provisions of MRSA section 4056A to discuss the evaluation of personnel and the consideration and discussion of appointments, employment and duties, and MRSA section 4056C to discuss the conditions, acquisition and disposition or real property or economic development if premature disclosure of the information would prejudice the competitive or bargaining position of UMS. Is there a motion?
So moved.
It's been moved by Trustee Martin. Is there a second? Second by trustee Riley. Kayla, would you take the roll?
Trustee Mishu,
Yes.
trustee McMahon,
Yes.
trustee McCarthy,
Yes.
trustee Martin,
Yes.
and trustee Riley.
Yes.
Motion carries. And one moment as I move you.